from Bangalore to Gurgaon and Noida to Bombay, call centers dot the Indian landscape. Being a relatively new phenomenon, they employ a very young workforce which earns enough to splurge on the luxuries such as top-end cell phones, expensive ready-mades, etc. Do these young people realize that their newfound financial independence is the result of somebody they do not know in the faraway land losing his or her job? In the last decade, American firms increasingly has been moving functions and processes to developing countries where they can be performed at a fraction of the cost. On the face of it, it seems like a zero-sum game, that somebody's loss is somebody else's gain. Or is there something which we are missing? Because all the trade theorists and economists have told us that trade is beneficial. But in this particular instance, isn't it a symmetric trade? No. The supporter of free trade will cry out. They will contend that only routine jobs are going overseas and cutting edge managerial and research jobs are staying at home. Also, they argue it helps in staving off inflation at home and consumer can buy more services at reduced prices. And lastly, the supporters maintain any economic growth of the developing nations will ultimately only benefit the developed world, and these nations will be able to afford the goods and services produced only by the developed world. For some time now, the supporters of this free trade theory have peddled theories such as Adam Smith's absolute advantage, Ricardo's comparative advantage, and more refined Heckscher-Ohlins theory. These elegant theories try to show that a nation should only produce something where its comparative advantage lies. Concept of mercantilism is derided as barbaric by them. Mercantilism states, in effect, that the nation should export as much as possible and import as less as possible. Comparative advantage discussed above is a function of factors such as land, labor, and capital. But factor endowment doesn't explain the current trade pattern convincingly. Moreover, the theories of comparative advantage rest on just too many assumptions, such as no transportation cost, no price differential, no switching cost, no exchange rate differential, etc. For example, these static models do not explain the diminishing and increasing return associated with specialization. So, do we have to look at some new trade theory, such as the one of Paul Krugman, to find answers? Paul Krugman's trade theory suggests that specialization in case of some countries developed because the world market can sustain only a few firms. That is, some industries are natural monopolies or duopolies. Think commercial aircraft industry. Only Airbus and Boeing dominates. This global domination cannot be explained by the underlying differences in factor endowments. For example, United States with abundant capital should be exporting capital-intensive goods, but that is not the case. US exports are less capital-intensive than its imports. How do you explain this paradox? As discussed, Ricardo theory is riddled by too many assumptions, and the Heckscher-Ohlins theory, while being theoretically more attractive, is not very predictive of real trade patterns. Answer probably lies in the differentiation that technology imparts. Product life cycle theory was proposed by Raymond Vernon in the mid-1960s. He observed that most of the new products in the 20th century had been developed in the US, and this technology breakthrough, coupled with the size and the prosperity of the country, ensures that US was motivated to keep developing new consumer products. High labor cost in the US, in fact, incentivize the firm to invest in more efficient processes. The manufacturing initially was based in US near the domestic market, and demand, also due to novelty, was not price sensitive. Thus, these ventures were profitable, and that obviated any need to shift to the low-cost manufacturing centers. As the market matures and the demand grows to even developing and underdeveloped nations, the price becomes a key differentiator. Thus, the locus of manufacturing has to now shift to low-cost centers. Historically, this theory has provided a reasonably accurate explanation of international trade patterns. New trade theory, on the other hand, emerged in the 70s and the 80s, when the assumption of diminishing returns to specializations was questioned. Argument emerged that increasing returns to specialization might exist in some industries. That is on assumption that nations trade with each other coupled with the economies of scale which global market present. There is mutual gain even when countries are similar in resources or technology. Just think, if economies of scale approximate the aggregate global demand, then only few firms based out of limited number of countries can be supported by the world market. Something definitely to chew upon.